All right, should we kick off? Good afternoon, everybody. Welcome to the 12B Green Energy Fund webinar. Thank you for joining us and taking time out of your day to join us. My name is Jeff Miller. I'm the Group CEO of Grovest Investment Holdings, of which 12B Investment Fund is part of our portfolio. And today we've got a webinar where we're going to unpack the benefits of investing in a 12B fund. And we're very happy to have with us Tivon Loubser, who is the fund manager of the 12B Green Energy Fund, and Vic Bucarizza, who is the wealth manager from GRB. Welcome, guys. Today I'm going to be your facilitator. I'm going to ask you lots of questions, and I'm going to hope that you can answer them and let the people on the call know exactly how 12B works and understand exactly what's in it for them should they invest. Some quick housekeeping. We're going to be strict on time. We are going to finish at 2 o'clock on the dot. There is an opportunity to ask questions. If you can just use the Q&A chat and ask any questions that you wish, and I will then pose them to the various guys on the panel, and they can answer it. There is CPD points available, so those who stay the full distance will be entitled to get a CPD certificate. There will be an opportunity to post your, all your details, so we can send your CPD certificate after the webinar. There is a recording, so those who missed today's talk will be able to get the recording on our YouTube channel. So guys, welcome. So before we kick off, Tivon, why don't you just introduce yourself, say a few words, and then I'll hand it over to Vic.
Yeah, thanks so much, Jeff. Good afternoon to all those joining us. So as Jeff mentioned, my name's Tivon. I'm the fund manager on the 12B Green Energy Fund. We currently live with our third vintage with the 12B Green Energy Fund 3. And I think we've had a number of learnings these last couple of years, and had some great successes as well. So keen to unpack the 12B environment a bit more. There are some distinctions with our newly launched Fund 3. So we'll get into that a bit on the environment as a whole, the renewable energy environment as a whole. And I think it's great having Vic joining us as well. Not only is he a wealth manager, but also sits on our investment committee. So he's got some nice insights into the funds.
Thanks, Tivon. Vic, do you want to just tell us a little bit about yourself?
Sure, of course. Hello, everyone. I hope you're having a wonderful day. My name is Victor. As Jeff mentioned, I'm an executive partner and a wealth manager at GRB Financial Services. And what that means is I've focused primarily on private clients, so generally high net worth individuals and families, but also across the board financial planning. And we've been working quite closely with 12B since inception a couple of years ago, identifying it as a unique offering for tax enhanced investing for clients, and utilizing it in that regard throughout. And as Tivon mentioned, subsequent to that, I joined the investment committee to crack the whip a little bit, make sure that the projects that are getting over the line of the highest quality.
Okay, thank you, Vic. So Tivon, let's kick off with you. Can you give us maybe a snapshot of what the South African market looks like in terms of energy, Eskom, challenges, the outlook?
Yeah, so I mean, a lot has changed over the last 2 years. And I think in order to kick it off, it's probably worthwhile taking a step into the past. And it's, for lack of better terms, and excuse the puns, a slightly dark past. So if we look to 2023, which is when we, really got moving on the 12B front, I think we had around 289 days of load shedding, 289 days of load shedding in 2023. And when you consider that 1 day of load shedding cost the economy and cost the country close to 900 million rand, I mean, it is an extremely expensive day out. I think Eskom posted losses in 2023 in the order of 23 billion rand. Agricultural sectors were hit hard. Our energy availability factors were hovering around 49 to 55%. You know, and when you compare that to sort of your global coal fleets, they should be hovering around 75%. And look, I think we were all privy to that. We all dealt with it and begrudgingly put up with it. But the one, I think, looking towards a silver lining, I think what Treasury did, which was brilliant, is they implemented or announced the 12BA tax allowance. And again, we'll decipher between the 12B tax allowance and the 12BA tax allowance, but I think that was a huge step in the right direction. Essentially, what the 12BA allowance did is it gave an accelerated wear and tear allowance for investing in renewable energy generating assets, and it was also an enhanced allowance. So not only were you getting the 100% tax allowance on your capital, you were actually getting 125%. Obviously, that was for a defined period up until the end of the 25 financial year. And then I think, Jeff, it was you dreamt it up in a board meeting how to structure these in-commodity partnerships so we could get the 12B allowance and 12BA allowances into the hands of investors. Since then, and I know Andre de Ruyter spoke recently, I mean, I think the private sector has had a huge impact on energy stability in South Africa. Our energy availability factors currently are in the mid 60s. I saw an article recently that mentioned somewhere above 70% even. So we really are getting up to those stable levels. Notwithstanding, there are still challenges. I think the cost of energy being one of them. And yeah, I think maybe the biggest outtake is since 2023, what we've seen in terms of deployment is a shift from energy stability to cost saving. And we can unpack that in some more detail.
Okay, great. So, Vic, you obviously represent wealth managers and private clients. And, you know, Tivon alluded to it. I mean, the private market has really solved, or to a large degree, has solved this problem of this energy problem in South Africa. Do you want to allude on, you know, just, you know, expand on that?
Sure. So, I mean, we live in a world where capital can be very useful. Labor is very applicable in itself, but coming from the private client's perspective, obviously we have a lot of money to be allocating towards problems that need to be solved. And this is a great example of a primary solution to a problem. Most investors invest on secondary exchanges. So you're buying shares from a third party who bought the shares, you know, 250 years ago, 10 years ago, whatever the time period is. This is an example of impact investing where one's capital is actually going straight directly into the economy, directly solving the problem, which has a really nice feel-good element to it. It's a rare opportunity for private clients or non-institutional investors to be able to invest in infrastructure projects of this nature. Normally, you need to be putting aside, you know, 50 million rand or something like that to be investing in infrastructure in a direct capacity. This is a great example where one can, where everyday South Africans, let me say, can potentially contribute towards solving this problem, which the government then, thankfully, as Tivon alluded to, put the rails in place so that we could get the train on the track and get it out the station.
So, I mean, in the main, I think we've seen now the end of load shedding, or to some degree. I mean, we know that Eskom's still burning lots and lots of money on diesel because there is downtime, et cetera, but we as consumers are experiencing very little, you know, let's say load shedding as we experienced in the past. Now, the whole idea of now moving to renewables is in terms of cost savings. Now, do you want to just talk about that, Vic, just the cost savings between that brown energy and that of the green energy?
It's a question we get from clients all the time, especially clients who invested in the first vintage of 12B when load shedding was sort of at its peak. Clients have asked the question, with load shedding withering away, is there still an opportunity to be investing in renewable energy? And stepping aside from the global trend towards renewable energy, if we look specifically at solar energy, it's one of the most cost-effective forms of energy production. It's clean, as everyone's well aware. And depending on how many battery packs, because the battery packs are the expensive part, depending on how many battery packs an installation has, the off-taker, i.e. the person who's consuming that energy and paying for it, can start off cheaper immediately than Eskom or than non-private energy. Or it might take a year or two, but the graph is the cost of energy through Eskom versus the cost of the solar, sort of a little bit more linear in that regard. So beyond the reliability, the sun shines more than 284 days or whatever it is in the year. Beyond the reliability of that, the cost savings can start immediately for off-takers, or in the long run work out better. So the appetite for projects is still quite deep, quite rich, and investors are chomping at the bit to be putting money towards these projects, because the returns from a project perspective are also very attractive.
Jeff, if I can maybe also just elaborate here. I mean, I think it's interesting to look at the cost of energy in the broader context. So relative to global averages and African averages, South African energy prices are slightly above average, but we aren't at that ceiling. You know, we aren't close to the prices that they're paying in Italy or Germany or Ireland. And it's kind of this warped way in South Africa. We like to do things to the utmost. So NERSA and Eskom don't have this upward pressure. And in my opinion, and I think our house view, these price increases, the 12, the 15%, are going to continue to come through. And again, as Vic mentioned, you know, we either giving our off-takers immediate cost saving from day one, providing tariffs as low as 90 cents, 95 cents, sometimes where Eskom's charging R2.20. But then we're also escalating at CPI plus a spread, normally CPI plus 1.5 or 2%. So you're also undercutting those escalations. So the long-term savings are brilliant. And it's sort of it's got quite a nice knock-on effect, because you saving your off-takers money, or you saving them on their OPEX, and ultimately you're taking a credit view on them. So you're actually able to put them into a better position as a result of the installation. And I think that's also a very important point.
Great. So Tivon, how does 12B, what is the role of the 12B Green Energy Fund? How can it now solve the problem of firstly, let's say off-takers now pegging their electricity cost to, going forward, or the escalations, and how does an investor actually take advantage of the 12B tax saving?
Yes, I think firstly talking to the mandate of 12B, I think we've got a very defined mandate, because it's pretty much prescribed by Treasury and the sort of the tick boxes that we have to go through in order to get the 12B allowance into the hands of our investors. So maybe just talking to the structure, we structure our fund as an N-D partnership. Essentially, all that means is it's a flow-through vehicle. And we pool investors' capital, so retail investors. Vic mentioned, this investment's very accessible to your everyday investor, and I think that's the beauty of it. So we pool those investors' capitals, and then we engage or interact with off-takers, creditworthy off-takers, through what are called power purchase agreements. These are long-term contracts whereby it specifies that they will consume electricity from us at an agreed off-take rate, at an agreed tariff, and with that agreed escalation that I alluded to. And through that, we're able to save them the large capex outlay up front. I think businesses want to focus on their core revenue generating lines, not having to put capex towards solar. And we provide them energy security, we provide them with low costs. And then on the converse side, we're able to provide a yielding investment to our investors, and we're able to get a very lucrative tax structure to them. So yeah, that's it in a nutshell.
So Vic, from a let's say from a wealth manager perspective, how important is it for, let's say, private investors to invest into, say, a solar fund, such as a 12B Green Energy Fund, and into alternatives per se, in order, rather than their, let's say, traditional vanilla investments, stocks and bonds?
Yeah. So there's a lot of research around the growing trend globally of investments towards alternatives. And there are a lot of different factors that one could consider as to why that is a growing trend. What I would suggest is alternatives by their nature are generally less liquid for investors, less accessible to something like you alluded to, stocks and bonds. So in my view, this should never be or shouldn't be someone's first investment. A 12B investment should be a part of a broader investment strategy for someone who's already been investing in other things. This is not, in my view, the place to be starting with one's investment portfolio. And it shouldn't be the full portion of anyone's portfolio. It should fit within a much more diversified portfolio, specifically around that liquidity risk. Or risk is maybe the wrong choice of words there, but the lack of liquidity, that accessibility issue. So for our clients, depending on the mandate, the structure, the goals of the clients, we've been allocating anything from zero, obviously not all our clients are invested, but for clients that are invested, anything from about 5 to 20% maximum of their total investable assets are going towards alternatives. And within that space, a good chunk of that would go towards tax-enhanced investments, such as a 12B investment. Some clients in special circumstances would push a little bit higher, but I think the big takeaway there is this should form a part of one's broader investment strategy, not be the entire investment strategy. And because it's a little bit more nuanced, or alternatives in general are a little bit more nuanced, which actually it's not a negative thing. In fact, the nuance or the lack of liquidity can lead to very positive investor behavior, because people don't necessarily make poor decisions and exit when the market is down, because you can't exit. But it should be seen as a part of the broader portfolio, and shouldn't be that first investment. Should rather be for someone who's got a little bit of experience under the belt.
Okay, great. So Tivon, you're now raising capital now for Fund 3. You've had 2 vintages, Fund 1, Fund 2, some special projects. Talk to us about the type of returns that you are, or your investor, or that you've achieved to date, both in terms of cash flow, tax benefits, and the next steps, if there are any.
Yeah, sure. So, I mean, I'll talk to the broader discussion around Fund 1 and 2. I think when we initially went to market with Fund 1, there was, I mean, we were met with a bit of hesitancy initially. I think it was, and that's the same for all new products. And, I think it kind of sounded too good to be true. I can get 125% back on my invested capital. So we were met with a bit of hesitancy initially, but I think, we worked hard alongside our tax advisors. We worked alongside SARS to try and really develop the understanding and make 12B a more household name. And yeah, so in Fund 1 to date, all our investors have gotten their tax allowances. We had one investor whose tax allowance was rejected initially by SARS. We then took it upon ourselves to escalate it with our tax advisors, and we got a favorable ruling on that. So I think that was really the test, the acid test there is, can we get the allowance into the hands of our investors? And I can say we've successfully managed to do that. And we're already seeing our Fund 2 investors starting to claim their allowances. In Fund 1, we implemented a small portion of gearing into the portfolio. So our investors actually got I believe it was around 100 and close to 140% tax allowance, as opposed to 125% tax allowance. So that was immediately a sweetener up front. And then in terms of distributions, as one takes on gearing, it does dampen the return slightly, but we're still yielding very strong cash returns. So we're yielding around 8% on average across both Fund 1 and Fund 2. We're about to issue around a 4.5% distribution in our funds for the half year to date. So that's quite exciting. So I think Vic mentioned it earlier, the impact investing narrative with 12B, but impact investing is always always secondary to getting a return. I think people first want to see a return, and then they want to know that they're also getting or also have a feel-good factor. And I think that's an important point. And I think 12B is the perfect example of that. We're able to get you your tax benefits. We're able to get you your yields, and we're able to also empower and lead to a greener and brighter future in South Africa.
So am I right? In Fund 1 and Fund 2, there was in Fund 1 there was limited gearing. Also, Fund 2 slightly limited gearing, and subsequent to that, you have now geared up those funds. So those investors who invested in Fund 1 and Fund 2, notwithstanding that they got their initial 12BA allowance, they are now, in addition, getting their 12B allowance for the next year, the following year.
Correct. So that speaks to our philosophy. So our philosophy has always been to deploy as much equity capital as possible. So we raise monies from investors, and we want to deploy all that capital before we take on debt financing. And there are a few reasons to that. One, we want to get as many people the 12B or 12BA allowance as possible. And secondly, we were of the opinion that we could get more favorable rates from our tier 1 bankers if we had a demonstrable track record. And evidently, we've experienced just that. So we've been given a large facility from our bankers at very favorable rates, and now we're able to reward our Fund 1 and Fund 2 investors with an additional enhanced tax benefits for the 2026 financial year end.
Okay, great. So, how are your funds tracking to what you actually promised your Fund 1 and Fund 2 investors?
So we targeted an 18% IRR on risk capital. So that's your return over the period. And currently we're tracking it varies between 22% to 23%, and slightly higher in certain cases. And that's in large due to us being able to still generate high cash yields while also giving those additional tax benefits. And I think that's probably where I'd say we've outperformed, is we've been able to balance the cash yields with the additional debt, and it again talks to our philosophy around our structuring.
Okay, so now, so Vic, I mean, what are, let's say, your clients? What are they asking you what do they want to see in a 12B investment? What do they want for you to demonstrate that for them to part with their money and to invest it into the 12B Green Energy Fund? What is it that they're looking to see?
Sure, a couple of things. So just building on the conversation now around returns, obviously with any investment, one is seeking to grow their money in a reasonable or hopefully a substantial way. So first and foremost, the quality of the projects, the expected return of these projects is of the utmost importance. If you strip out the tax benefit, I think you still see that the returns are very attractive, sort of mid-teen level returns, roughly speaking. Over the period, these are the expected returns. And as Tivon has said, they're tracking at these expected returns. Then beyond that, the tax benefit enhances this return overall. From our client perspective, there are a few different clients that would be attracted to that tax benefit for different reasons. So some examples that are a little bit nuanced maybe, or let me start, straightforward. A high earner in South Africa, a high taxpayer, has few opportunities to create a tax deduction for themselves whilst also seeking out positive returns. Pretty much they can contribute towards their retirement fund, which creates a tax deduction, but has limits as to how much one can contribute, and then also has some sort of accessibility limits. And then you have 12B, where you're uncapped into how much you can contribute or how much you want to contribute. You get a nice, healthy tax deduction as you would with a retirement fund, although because of the gearing, it's a little bit higher from a tax deduction perspective. And then you're now getting these attractive returns. So the sacrifice that investors need to be aware of is that time horizon, that liquidity, that accessibility, which roughly speaking is a 10-year time horizon. They need to be comfortable not being able to access that full portion. Although they will be receiving income semi-annually on that, they won't have the access to the lump sum. Some unique circumstances are clients that have big CGT bills coming up. So a client who's got a big share portfolio that they want to move around or wind down, something like that. clients who are selling property or exiting a business or anything like that. Anytime there's a big fat CGT bill, people are reluctant to realize that CGT bill, even though it might be the smart economic or commercial thing to do. And so 12B can step in and make that decision a little bit easier, because that tax burden can be alleviated slightly by allocating some of the proceeds from that would have gone towards SARS towards 12B and creating a tax deduction for it. There's also been some interesting cases where we've had some family trusts or some individuals who are changing tax brackets. So for a good example is someone retiring in the next couple of years, where they're in a high tax bracket now and they'll be dropping to a low tax bracket in the future. So they get a really attractive tax deduction now while they're paying a lot of tax. And then the income on the projects over the 10 years will be paid to them when they're in a much lower tax bracket. So there's a bit of an arbitrage there, I guess you could call it. But I think to summarize my response to your question, Jeff, returns are non-negotiable, need to be attractive. We can't just say, well, this gives a tax deduction, but there's no return capacity there. Secondly, the tax benefit becomes a great point of entry, a great enhancement, especially if there's certain triggers like a CGT event, high taxpayers, someone who's exhausted their retirement contributions or anything like that. Other questions clients are really asking is around the viability of the investments, understanding the gearing. Is the gearing adding too much risk to the portfolio, which I would say there's conservative gearing within this portfolio. So it's hopefully not adding too much risk, but it is serving to bolster returns and amplify things. And then there's questions like things we've spoken about around load shedding, around the ability to get that tax deduction through SARS, which it's extra forms, but everyone's gotten it over the line. So it's really around that. And then just understanding, and we hammer on about the lack of liquidity, which I've done in this webinar already. We hammer on to clients about that. It's not a normal investment where you can invest today and in 2 years' time decide you want a third of your money back and that's it. This is an investment where you have to be very happy and comfortable parting with your money, getting that very attractive tax deduction, receiving your income on an ongoing basis, but then leaving the projects alone for them to play out over time.
So let's just talk about the structure of the investment or the fund, the in-commodity partnership. Do you want to just talk that through, Vic, and explain how investors actually can benefit from the in-commodity partnership?
Yeah, sure. So an in-commodity partnership means that you have GPs and LPs, limited partners and general partners. Investors are called LPs, limited partners. And that word limited means that they're basically limited to whatever money they invested. That's their money at risk. They're not, if the partnership blows up, goes bust, gets sued or something like that, the limited partners don't have to handle that. They don't have to deal with that. They have limited liability. The general partners then have to take on that burden and that risk. The partnership is very intelligent in its design. I know, Jeff, you're the one who came up with it, so there's a compliment there. But the partnership is very intelligent in its design because it creates a ring-fenced mechanism or entity whereby all the tax benefits can be passed on along to clients, because a client could go and invest in their own name. I could go and I can invest in a solar project and I will get that tax deduction. But then I'm subject to all the deviances of owning that project, all the liabilities, all the difficulties, all of that jazz. So what the partnership does creates this isolated little vehicle whereby investors can invest into a full suite of projects. Their distributions can come through to them, taxable, but the tax deduction is then also flowed through to them as an investor. So it creates this vehicle for that, creates a diversified portfolio. It also creates an entity that can gear on itself within that in-commodity partnership. So it's really just this look-through entity that's designed so that the end investor can gain the tax benefit, the return benefit. They do have to handle the tax burden on those returns, the income on that, but it works out perfectly fine for them, whilst limiting their exposure to the downside of these projects. Tivon, I don't know if you want to build on that.
No, I think you've covered it perfectly. Yeah, it's really all built around that flow through structure, and I think the limited liability nature of these structures is also a very attractive add-on or risk mitigant, I guess one could call it.
So, Tivon, obviously you know your off-taker is who you laying out this money. You're entering into a power purchase agreement for 20 years or 15 years or whatever it may be. And obviously one has to take a risk on that off-taker. Can you just talk about the risk, how you assess the off-taker risk when you actually construct a portfolio?
Yeah, I think I'll take one step back and look at what are the risks present within these 12B investments. And you've touched on one, counterparty or credit risk, and I'll elaborate on that. But maybe firstly, you've got the deployment risk. Are the funds going to be deployed in the current tax year so I can get my tax allowance that I've been promised? And are those deployments going to be of high quality nature? So we're very diligent in not taking on more capital than we believe we can deploy in a tax period. And to date, we've been very successful in that, getting them their full, getting our investors or limited partners their full tax allowance. And then we also do extensive vetting of any engineering, procurement, and construction counterparty EPCs who actually do the installations. So we've got a list of vetted EPC counterparties who do our installations. And we've got other mechanisms of holding them accountable, entering into operations and maintenance with the same installers, as well as some warranties and guarantees. But the biggest risk in this investment is without a doubt credit risk or counterparty risk. And as you mentioned, Jeff, these are long-term contracts. You're looking anywhere from PPAs range from 25, 20, 15 years. We are seeing shorter-term PPAs now. What's nice about those is you're getting a higher cash yield early on because you're essentially accelerating your repayment. But I think taking a long-term view on any counterparty in South Africa specifically is tough. In order to mitigate that, we've got an extremely experienced investment committee, and we've got one of our members sitting here today. As I mentioned, Vic sits on our investment committee. We've then got an independent investment committee member, Derek Finlayson, sat on the main investment committee of IDC, headed up the Stanbic and Stanlib boards for a number of years. Malcolm Siegel, the ex-chair of Grant Thornton, also sat on the main investment committee of IDC, extremely experienced and diligent there. And then we've got Amrish Chetty, Harvard-educated corporate financier, and they really do put us through the ringer. I think we've got some great anecdotal stories of turning away projects which otherwise, one would look at and say, on the face of it, it looks like a good project, strong balance sheet, huge balance sheets, strong lenders, and we've turned them inside out and said, we actually don't want to be party to this transaction. And in hindsight, it's been nice looking back at some of those. So yeah, going through extensive credit committee process, deal forum, and then looking for security packages. So whether it's in the form of a cross guarantee, deposits, or the like. And then further to that, I think because the nature of the investments, you're investing in hard assets. So if I invested 100,000 Rand into the fund, I essentially have my claim to 100,000 Rands worth of hardware, whether it be the solar panels, the inverters, the batteries. That also provides a degree of security. And one has to run one's loss given default analysis on the hardware. There is obviously a lot of groundworks. There's a substantial portion of capital spent on the installation itself. But that is nice recourse as well. We know that we can go uplift the equipment in the worst case scenario, and redeploy that elsewhere.
Okay, guys, thanks, Tivon. Before we carry on, I'd like to just put out a poll so we get some sort of idea of, get some feedback as to the status of the 12B landscape. Can we post the poll, please? So just to ask you, how familiar are you with Section 12B? And the tax allowances, and if you can just tick one of the boxes so we can get some sort of idea of our participants on the call.
I think the one question that I'd maybe pose to Victor while we ask this question is, are you seeing 12B investments, and I'm talking to the universe here, not just the 12B Green Energy Fund, become more become more of a household name? Are people understanding it now, and well, your investors who have invested today seeing the benefits of them?
Yeah, the short answer is yes, they're seeing the benefits. Is it a household name and something that people are very aware of? I would say mostly not. There are people that follow things quite closely and see various advertisements and that sort of thing. But to understand the nitty-gritty of the infrastructure, to understand exactly how it works, I don't think it's commonplace for the South African. But it's great to see the expansion or how the private sector has jumped on the 12BA and now the 12B tax incentive and created these opportunities for investors. Again, not just speaking to the 12B Green Energy Fund. It's great to see that opportunity taken up with both hands, and South Africans or South African investors applying their capital to building the nation together. I think there's a really wonderful thing about that. But generally speaking, most of the individuals we talk to, it's their first time that they've really dug into 12B as a benefit. If they've heard of it, they maybe know that there's some sort of tax deduction, or that's it. A lot of people also confuse the 12B allowance with the solar panel individual, I forget what it's called, but the incentive to get money back if you install your own rooftop solar panels. It's a different thing. I think a lot of people think that's what we're talking about initially, but then very quickly realize there's a lot more going on behind the scenes there. So yeah, appetite is strong, knowledge is still improving.
Can we post the results of the poll one, please? We got that? Okay, while we're waiting for that, we'll just continue and then, oh, there we go. So a 33% very familiar, 26 somewhat familiar, heard of it, 36%, and those are the guys we now need to get to understand and know more so they can consider the product, and they're not familiar at all, 5%. Okay, so thank you everybody for your participation. There will be some other polls during the course so we can get some sort of idea. Tivon, you mentioned risk. This investment is, as you said, for long term. What is post-investment management look like?
Yeah, so I mean that's one of the most important factors, I guess. One is upfront due diligence and making sure you're happy to get into a long-term relationship with these counterparties, but then it's handling that relationship going forward. And the one thing I always say is I think the 12B funds are probably some of the more operational funds in their nature. We're doing ongoing operations and maintenance, so we're making sure we track the performance of each site. Is it tracking to what it's meant to be yielding? Are we maintaining the systems well enough so that we're not seeing massive losses through irradiance and making sure we're getting out and cleaning the panels? And then we stay in constant communication with our off-takers. Obviously, we're billing them monthly, so we can very quickly see if someone is late to payment. I must say to date, all our off-takers have been extremely diligent. Granted, we are only on fund 1, 2 years in, but haven't had any red flags or issues whatsoever. And then we also
your tough investment committee.
Yeah, well, kudos to Vic. And then also just within our power purchase agreements, we've got factors built in, like the off-takers having to provide us with financial statements on an annual basis, so we can keep up to date with how the businesses are tracking and look out for any early warning signs. And I think it's a fundamental part of the investment process. And then also the other stakeholder management is with our own counterparties. Make sure they're doing what they said they would do, and if the systems aren't performing to spec, we have our recourse there as well.
So, Tivon, I understand that all the systems are insured, and talk to us about the insurance and how important that is.
Yeah, so we've got all risks insurance and business interruption insurance on our plants. And we've had a few cases. So we had a huge windstorm here in the northern suburbs in Johannesburg, in Birdhaven, that actually blew off some of our panels, notwithstanding that they had all the weighting requirements needed. And these events do happen, and I think we're very familiar with that. So we've got insurance, all risks insurance on the panels, our brokers being GIB and our underwriters being FireDart, and we've had successful payouts to date. And then on top of that, we've got business interruption insurance. So often if something goes wrong with the system, you're out of the money for call it a month or 2 months. So we've got insurance cover in that regard as well, where the insurers will pay out what we would have earned in the normal course of events.
Thanks. Vic, what do you think that the investor misconceptions are investing in green energy funds?
That's an interesting question, Jeff. I think the first one is probably, if you're going to do something that's so pro-environmental, so pro-social, that you're probably going to sacrifice some returns, which is not the case here. I think the returns are adequate to be understating it. The returns are very attractive. So that's probably one of the bigger ones that investors think that's the case. Again, that this is different from a regular investment where something is listed on an exchange and you can just find someone else to buy your shares and you can exit. So having that long-term hands-off mentality is something that just needs to be hammered in from a client perspective. Sometimes there's potentially a little bit of a misunderstanding because the power purchase agreement, so the contracts that govern the relationship between the fund and the off-taker, can be long-term in nature. They can be 15 or 20 years in nature, but the investor experience is targeted to be a 10-year investment. So at that point, if there's a 20-year power purchase agreement, those power purchase agreements themselves will be sold off to third parties and then liquefied and given over to investors. So just understanding that full investor experience is one makes the investment, they do their tax return and either pay less tax or receive their tax refund. And then every 6 months receive a cash flow, a growing cash flow. And depending on the level of gearing and that sort of thing, how much is used to pay off the debt, that might start low and grow very rapidly and grow till year 10 and then exit with a lump sum at year 10. I think that's the big experience that investors need to be ready to sit tight for. Some investors have asked whether they could reinvest those cash flows. And unfortunately, the nature of this is you could potentially reinvest it if a fund is open, but these are funds that are close-ended. It's not an open-ended thing that's just always rolling cash. There needs to be projects available. There needs to be the ability to deploy that capital in order for money to be reinvested. So I think it differs from what clients are used to, where they don't need the money and it's coming through and they think, well, let me rather just reinvest this. That's not always the opportunity available. There are certain windows when investing is available. Clients must invest during that time and then await for the next window of the funds to be available.
So talking about windows, Tivon, maybe that's a nice intro for you to talk about raising capital for your Fund 3.
Yeah, so we currently in our raising cycle on our third vintage, and we've got some really exciting projects. What we're actually seeing is a number of blue chip listed entities now looking to finance solar through PPAs. So the bulk of our Fund 3 projects now are going to really blue chip counterparties, and that's exciting to see. So yeah, we're currently in our raising window. We've had brilliant uptake to date, and we probably going to be closing around November again, just so we can make sure we deploy all that capital. But really, I think out of all the funds to date, just looking at the counterparties involved, Fund 3 is really well poised. Yeah.
So Tivon, we've got some questions, and guys, please, I'm asking that should you have any questions that you wish to pose to Tivon or Vic, please use the chat icon on the screen and pose your questions, and don't be shy. Any question, we will try our best to answer to the best of our ability. But we have a question here, and what are the typical sizes of the solar plants, Tivon?
Yeah, so in Fund 1 and Fund 2, we did a majority of sort of behind the meter solar installations for your commercial and industrial off-takers or your body corporates. So they tended to be slightly smaller in nature. We had a big exposure to a big installation on a gold tailings plant in the northwest. But for the most part, they were smaller, so 1.5 megawatts and below. And what we're actually seeing now with Fund 3 as well is there is a bit of a shift. So it's larger scale rollouts. And we're actually also exploring the opportunity now of wheeling. So we've got 10 megawatts solar farm with, again, blue chip off takers. So that's also an exciting endeavor.
Okay, great. So I mean, so you just in summary, you're actually seeing that the movement again is again from let's say energy security to let's say energy savings, and the big blue chips, the big industrial companies, the big retailers are now utilizing solar in order to curtail costs because of the increase in that of the Eskom tariffs.
And I think maybe just on that, the one thing we are seeing in the solar industry is that pricing has become somewhat commoditized. So while we're still getting strong yields, one does have an upper ceiling. So it's not a Wild West where you can price whatever you want. And I think that's the other thing to take into account. But as you mentioned, far more blue chip off takers. So when you look at risk commensurate or reward commensurate with the level of risk, I think it's looking good.
I think.
So what is the?
Sorry.
Go ahead, Vic. Sorry, go ahead.
So the way I like to think about it from an investment committee perspective is the main operational problems, if any, are not going to show up in the early years of these investments. They're going to show up in the latter years. And so having blue chip off takers or predictable long-term partners at inception is pivotal. If you're taking a 20-year view on something, it having been around for more than 20 years, having been profitable, successful, built up a strong balance sheet, those are important things to look out for. Not exclusively, but they are important. I think also to Tivon's point, these are infrastructure investments. And so there's no single investment that's going to somehow miraculously shoot the lights out. That's not how they're built. They're built to have a ceiling of an expected return. And what we're looking for is to make sure that they hit that target, not fall short. So we're playing defense. We're not playing attack necessarily in this regard. All or most projects of certain sizes and sectors, that sort of thing, will yield pretty much the same kind of return based on the power purchase agreement. What the investment committee is trying to do is, yes, make sure the power purchase agreement is robust and well constructed, but then importantly, making sure that the off-taker will be able to service that power purchase agreement as is their contractual obligation. So it's downside protection that we care about. The upside will take care of itself because it's baked in to the contract. And so these blue chip off-takers are very useful for that. Notwithstanding that, Fund 1 and Fund 2, I think, had some high quality, has high quality off-takers there as well. But Fund 3, it is enjoyable to see the caliber of company that's coming aboard.
So we've got a question here about the exiting in year 10. Like in terms of exiting the PPAs in year 10, Tivon, can you talk to, how that is, what the mechanics are for that?
Yeah. So as we've mentioned, some of these PPAs tend to be, lots of PPAs tend to be 20 and or 15 years. What we do at a portfolio level is we make sure we've got an adequate blend between shorter term PPAs, so your 10-year PPAs that come to their natural end of life, and then your longer term PPAs like your 15 or 20-year PPAs. The way we exit that is by selling it to a third-party funding house, and we've built in a discount on the sale of future cash flows. It's very common practice in the industry. So just as we go along and buy our portfolios, it continues to be an activity. So you're essentially buying future cash flows at a discount. And it was interesting drawing comparison to the fiber industry. There were a number of microfiber installers with their books, and a Remgrow company by the name of Dark Fiber Africa came along and acquired all these fiber contracts. So it's a very similar mechanism. And I think if we are in a position, and if we are placed in 10 years' time to do so, I think we would like to start accumulating all these papers. And yeah, I think it's you're essentially buying cash flows at a discount. So it's an attractive task.
I think it's also possible there, sorry, Jeff, for a non-taxed entity to want to be buying the cash flows. So for example, a pension fund might look at the yields and say they're getting a 13-14% return quite predictably. That might be a path to exit as well. They're not interested in the tax deduction, which they won't receive, but they are interested in the cash flows.
Some question is, what is the minimum and what's the maximum amount to invest into the fund? Tivon, can you take it on? And how long the money should remain in the fund for?
So the minimum investment's 100,000 Rand, and unlike the 12J investments where you were capped at a maximum investment, 12B doesn't have the same cap, so it's an unlimited investment size. And then the investment, it's a 10-year investment. So as Vic has mentioned, it is a more illiquid asset, or the assets themselves are liquid, so they're yielding annually, but you can't trade in and out of them like your traditional investments.
And then another question is, when you exit the fund in year 10, what are the tax consequences in year 10?
So that's a brilliant question. So your income in year 10 is obviously taxable in the hands of the investors. And then when you exit the investment, there will be a recoupment. But what's nice is that recoupment is only up to the tax value of that asset, or the 100% recoupment. So you'll never be recouped up to 125% in the case of our Fund 1 and Fund 2 investors. And that has all been factored into the returns.
But in terms of Fund 3, so if one exited in, the 12B allowance is an accelerated depreciation allowance, which you would claim once the asset has been deployed in year 1. And then when you sell it in year 10, there's a recoupment up to the amount of the depreciation allowance that you've taken, and anything above that we sell the asset for would then be subject to capital gains tax. Can you confirm that?
Correct.
Okay, great. And then we've got there's some about costs, the return that you've said that you're achieving your 20% or 22% or 23% IRR. Is that net of all fees, including legal costs?
Yeah. So especially in Fund 1 and Fund 2, we had some legal fees that we had to incur. Obviously, the working with SARS and our tax advisors to make sure the whole investment was compliant. So all the returns that are quoted are net of our fees, the management fees, the legal costs, and any OPEX at the partnership or at the project level.
Yeah, so just some other questions. If I can just clarify, it says SARS closed down the tax allowance at the end of Feb 25. How come you're still claiming the tax allowance? 12BA was closed at Feb 25. That was open for 2 years, but 12B. So 12BA was 125% accelerated depreciation allowance, while 12B, which is still in existence, is 100% accelerated depreciation, which Fund 3 is investors in Fund 3 will get to. And your targeted IRR, notwithstanding that there's only 12B in place, Tivon, what is that for Fund 3?
So again, the beauty of being able to introduce a bit of leverage is that we're actually able to enhance that 12B allowance from its 100% to 125 or 150%, depending on how much gearing we bring on. So we're targeting a 23% IRR.
So am I right in saying then that Fund 3 will introduce gearing during the course of the fund?
Yeah, 100%. So again, we'll focus on deploying as much equity capital as possible up front, and then bringing those geared projects into the portfolio at a slightly later stage, or even incorporating some of that in the current year.
And what does the pipeline look like? I'm conscious of time, so I'm going to rush you.
Sure. Yeah. So as I mentioned earlier, the pipeline is, I mean, we've got a pipeline of over 500 million rand currently, which includes blue chip clients, listed entities. We're currently rolling out, I think it's close to 40 million rand with a listed entity across the country, and some interesting solar farm opportunities as well. So all round, it's looking promising.
So guys, I think we've addressed all the questions that have come through. Maybe there'll be some one or two that can come through now. And I think we've got a poll two, that if we can post that, and yeah, so poll two, if you don't mind filling this out, and then we can also just give you some feedback on that. Is which aspect of 12B is most attractive to you? Upfront deduction, renewable energy exposure, regular distributions, and diversifications. And Tivon, I also want you to talk about, if you don't mind, about carbon credits, because I think that's quite important. You're on mute. You're on mute.
Sorry, guys. Yeah, I'll keep it brief, but it's another really nice component of the investment, and it's not something we actually factor in when calculating the returns. For every megawatt, or for every ton of carbon you offset, or carbon equivalent ton you offset, you're actually able to generate carbon credits. And it's been a lengthy process. It's quite tough without the the best legislative framework in place. But we've just got our first pool of carbon credits audited by Vera, who are the auditing body or regulatory body. And in ordinary course of business, carbon credits can have a yield of anywhere up to 3% on the capex. So you're actually able to see an uptick in your investment return as a result of the carbon credits. But very complicated things. It's quite a nascent topic. It's quite a tough one to wrap one's head around, but one we're pursuing, and one we quite far down the line with.
Great. So as we come to the end, Vic, I'm going to ask you for some closing comments.
Sure. I think just to summarize everything, I think if someone's paying a lot of tax or expecting to pay a lot of tax, this is a great tool to minimize that tax whilst buying into very positive return projects, doing some good for society and doing some good for the environment. But they need to recognize that not everything is for free, and the sacrifice they're giving up is liquidity. But if it forms a part of one's broader investment portfolio where they have other sources of access to capital, then it should be a part of everyone's portfolio in some way. And if you're happy to have that illiquidity, you're going to get a really solid investment, strong team, strong pipeline, and I think feel comfortable with that.
Thank you, Vic. Tivon, for your closing comments, and for you, so there we have the results. People are interested in the upfront deduction, 63%, with equal probably distribution about renewable energy exposure, regular distribution, and diversification. Can we post poll 3, because I know we're a bit late, but at the same time, Tivon, if you could just tell us if anybody is interested in investing in your 12B Green Energy Fund 3, what's the next steps? What's the mechanics? How do we, how do you get them to, how do you get to assist them?
Yeah, so I think answering poll 3 will help with that. So we'll reach out to anyone who wants us to. Otherwise, you can find us our details on our website, 12b.co.za, or you can reach out directly to myself, Tivon at 12b.co.za, and happy to have a meeting or go for a coffee to unpack it a bit further.
Great. So just on behalf of myself, I'd like to thank you, Vic and Tivon, for taking time out. I think it's been a very, very interesting talk. I mean, I think we've unpacked not only the mechanics, the industry, the 12B, the risks, and the like, how we differentiate ourselves between us and other opportunities in the market. And thank you everybody for joining us. For your CPD points, please look out for the registration, and then we will get the CPD points back to you. Please feel free to reach out to myself or Tivon should you require any further information. And then also, also if you to Vic, to GRB, should you're looking for just some general wealth management advice, experience, he's a good boy to talk to. I can highly recommend it. So please get hold of Vic at GRB. So thank you everyone for your attendance. Thanks for joining, and have a great day further.
Thanks, Jeff. Thank you.
Okay, you must claim the CPD points. They need to, yeah.